Hey there! Let me guess. You've heard that investing is the secret to building wealth, but the whole thing seems overwhelming. Don't worry, we're going to break this down into simple, actionable steps. By the end of this guide, you'll understand exactly where to put your money and how much you're allowed to invest in different accounts. So let's look at the main types of investment accounts and their annual contribution limits. First, 401ks if you're in the US, and RRSP if you're in Canada, the tax deferred accounts. The 401k or RRSP is your tax ninja backpack. In here, you contribute pre tax money, meaning you pay less tax now. The catch: the tax man comes knocking when you withdraw in retirement. In 2025, the 401k allows for contributions of up to $24,000 if you're under the age of 50 and $31,500 if you're over 50. Many employers offer matching contributions. This is free money you don't want to leave on the table. For example, if you make $60,000 and your employer matches 100% of your contributions up to 6% of your salary, you'll get an instant 100% return on your money before it's even invested. If your company offers matching, always contribute at least enough to get the full match. It's the easiest raise you'll ever get. It's like buying one pizza and getting another one for free. Every dollar you contribute to the 401k lowers your taxable income. For example, if you make $80,000 and contribute $12,000, your taxable income drops to $68,000. Considering a 22% tax bracket, this could save you $2,640 in taxes. However, you'll be taxed in the future when you withdraw the money from your account. The RRSP is very similar to the 401k, but has some key differences. The RRSP allows for contribution of up to 18% of your previous year income, but only up to $32,490 in 2025. However, one of the key differences to the 401k comes here. You can carry unused contribution room to future years. For example, if you made the same $60,000 in 2024 and only invested $6,000 in your RRSP, you would be using only 10% of your previous year's income. The remaining 8%, or $4,800, will be carried over to the following years. So in 2026, for example, you'll be allowed to contribute up to 18% of your 2025 income plus 8% of your 2024 income. Contributions to the RRSP also reduce your taxable income now, and withdrawals are also taxed as income in retirement. Then there's the Roth IRA if you're in the US, or TFSA if you're in Canada. The tax-free wonder backpack. You pay taxes up front, but withdrawals in retirement are completely tax-free. It's perfect if you think tax rates will be higher later. In 2025, the Roth IRA allows for contributions of up to $7,000 if you're under the age of 50 and $8,000 if you're over 50. Differently from the 401k, employers don't generally offer contribution matching to Roth IRAs. On top of that, if you're single and make $165,000 or more, your contribution limit will be zero. If you're married and file taxes jointly, your contribution limit will also be zero if you make more than $246,000. Another difference from the 401k is that you can withdraw money at any time, but beware. You'll be taxed depending on how much you withdraw. The Roth IRA allows you to withdraw tax and penalty free. Only what you contributed, not your earnings. So let's say you invested $7,000 and your money is now worth $10,000. You are more than welcome to withdraw the $7,000 you invested, but will be taxed and penalized if you want to touch the $3,000 earnings. However, this rule ends when you reach retirement age of 59.5. You can withdraw all your contributions and it's growth tax and penalty free if you first contributed to your account at least 5 years prior. The TFSA is also similar to the Roth IRA, but has some key differences as well. The TFSA allows for contributions of up to $7,000 in 2025. However, differently from the Roth IRA, your contribution room also accumulates from year to year. More interestingly, the TFSA room starts counting when you turn 18 years old, even if you don't start contributing at that age. For example, let's say you turned 18 in 2020 and only started investing in 2023. Your total contribution room will be $31,500. If you were already 18 or older in 2009, when the TFSA was first introduced, you get all past unused room straight away. Another difference is that you can withdraw contributions and earnings at any time free of taxes and penalties. Finally, the brokerage account is your no rules backpack. Here, you have no tax perks, but you also have no limits on contributions or withdrawals. This account is great for medium term goals like buying a house. Now that you know the limits, where should you actually open these accounts? For hands off investors, robo advisors like Betterment, Wealthfront, or Wealth Simple are perfect. Answer a few questions and they handle the rest. Low fees, zero stress. If you want more control, try Fidelity, Vanguard, or Charles Schwab or Questrade. These offer everything from retirement accounts to low-cost index funds. Canadians love Questrade because you can buy ETFs for free. For stock lovers, Robinhood and Wealthsimple Trade make buying stocks and ETFs easy. Just don't get sucked into day trading. We're here to get rich slowly, not lose money fast. Now, you might be thinking, okay, I know how to get started, but how do I know what to invest in? Well, I've got good news for you. Check out this video where we go through all the different investment types and find out what's good and what's not so good. And if you're thinking, but I don't have enough money to start yet, don't worry, we've got a full video for that too. So there you have it, a simple guide on the different investment account options. Your mission, should you choose to accept it, is first, open one account this week, even with $10. Second, set up automatic contributions, make it painless. Third, share this video with a friend so you can both geek out about investing, because in 20 years, you'll either be sipping margaritas on a beach or wondering why you didn't start today. Be the margarita person. Drop a comment below. What's your first investing move? And hey, thanks for watching. Now go make your future self proud.